Good afternoon, everyone, and welcome to AXA's full year 2015 results. Welcome to those on the telephone, welcome to those watching by webcast, and indeed welcome to those here in the room in London. When we get to the Q&A, as per usual, we'll be happy to take questions from over the phone or the webcast, and I believe you have the instructions in order to be able to do that. We will give a preference to questions coming from our friends here in the room. Presenting today will be Henri de Cast, Denis Devan, Jean Alain, and it's my pleasure to hand over to Henri.
Denis was asking me if I had taken a piece of chocolate cake, and I told him that I resisted, but will certainly succumb at the end of this presentation. So very happy to be with you this afternoon to share with you what our 2015 results have been. And as you have already seen, I think they are pretty strong because we are showing strong earnings and a good dividend, because they also illustrate the fact that we are coming to the end of the 5 years journey, which was Ambition AXA. And we have completed what was a journey with a satisfactory outcome on all the key KPIs, and this despite the fact that the economic environment, and in particular interest rates, have not been what we were anticipating at the very beginning of the exercise. So despite the headwinds, we have reached or exceeded the targets we had. Having said that, and even if I come back to some of these achievements in the presentation, this is not the end of the story. What we are focused at now is not to celebrate the past, but to look at the future. And I think we've built a very, very strong basis to reach the next step with the group. And as you know, it's something we'll share with you around mid-June. So the earnings in 2015, strong growth in earnings, of course, helped by the Forex. But I mean, on a constant basis, they are up 2%. We are reaching 5.6 billion in underlying. It's the highest level of earnings ever reached by the group. Adjusted earnings, same progression at 6 billion. So we are just in the range we have been forecasting in terms of capital gains. Underlying earnings per share up 10%. Adjusted earnings, which are the basis for the dividend, up 9%. That's why we are proposing to the shareholders' meeting to approve a dividend of 1.10, which is an increase of 16% when compared with last year. And seeing that, you see that we are walking the talk on the increase in the payout. We announced back in November the fact that the payout range would move to 45-55%. We are at 47%. Just a quick look back at what we have achieved with Ambition AXA. We had three key objectives with that. More selectivity in our business, because we thought that there were places or business segments where the returns and the development prospects were not optimal, and we thought we had to divest them. We wanted to accelerate, especially in the emerging countries, because we thought that at the very beginning, the AXA footprint in these places where significant growth would happen over time was not sufficient. And the third thing was to generate more efficiency and cut costs whilst still investing in the future. I think where we are today is pretty satisfactory from that standpoint, because we are achieving a high return on equity. We have a very strong balance sheet illustrated by the Solvency II ratio. We have very resilient earnings. I think you've seen that throughout the years. We have a better diversified footprint, both in terms of business segments and in terms of geographies. And last but not least, and this is going to be a very important element for the future, I think the momentum we have created on digital and big data is such that we are well positioned to take a very significant advantage out of these things. Just to go back to what were the key indicators, earnings per share have improved by 7% a year on a compounded basis, so exactly in the middle of the range we had announced. The return on equity is at 14.1%. The cash flows generated over the period have been higher than what we had announced, and the debt gearing is at the bottom of the range we had decided. By the way, we are going to slightly change, as you know, the way we report the debt gearing to align our reporting with what other players in the industry are doing, and Gerald will mention that, of course. Solvency II, we have disclosed in November everything, so you know us as well as we know ourselves there. The ratio is at 205. So far, it seems to me that it is the highest ratio published in the European industry. And we've told you that we would navigate between 170 and 230 with we have given you a pretty precise roadmap there. We are giving you here some sensitivities to illustrate our resistance to extreme scenarios. And since I'm sure that some of you are wondering where we are today or where we will be tomorrow I think you have here all the elements you need to understand that we are in a very, very comfortable situation from this standpoint. Debt gearing I've already mentioned. The discipline is illustrated by the numbers who are on this page. In 5 years, we have sold 9 billion of assets. Operational assets. We have invested for 6 billion, 5.1 of them to be precise being in emerging countries. We have a low sensitivity to interest rates, less than or around a 1 year duration gap, an impact of 200 million a year if rates negative, if rates stay at the current level. Our asset portfolio is of very good quality. We've shown to you here the average rating of the bonds, and we've given you the exposure because it seems to be the fashion of the day. What's the exposure to banking? What's the exposure to oil and gas? You've it here. Gérald Ordonny will come back to that. The 2% or the 1% apply to the general account assets, so a little more than 500 billion. So, the exposure we have there is a very good quality exposure. The next point is what have we been doing to shift the business mix and increase the margins? And there I think over 5 years the picture is pretty impressive because not only did we change the business mix in life, reducing the amount of general account in the new business, which has grown over the period, but we've also very significantly changed the margins on each and every segment of the business, which puts us in a situation where APEs are higher than before and where the margins have progressed by approximately 50% over the period, moving from 22 to 34%. On the P&C side, the game has been a game of reducing the combined ratio by a little more than 3 points, whilst generating nevertheless some revenue growth. It's clear that the P&C business is a business where growth is challenged, but you see that we can resist pretty well. The footprint in Asia and in other emerging markets is way stronger than what it was back in 2010. As I said, we have invested a little more than 5 billion in these markets. There has been a place where we've been disappointed. It's clearly Central and Eastern Europe. Fine. But Asia certainly has delivered, as well as Medellin, where we have very good and significant market positions, which we think will pay off in the long term, even if there is volatility around the trend. Just to illustrate Asia, APs have been doubling, the NBV has been nearly doubling, and the cash earnings we've been extracting from Asia are at 2 billion over the period. The last leg of Ambition AXA was the efficiency. The initial target was 1.5 billion of savings. We have achieved 1.9, whilst investing a little less than 1 billion in the new technologies. So we've been able to improve the efficiency of the group without sacrificing the future, which I think is an important element. This digital transformation keeps gathering momentum. As you know, we have 3 levels. What do we explore? That's the AXA Labs. What do we start to do? Where do we build tools, applications? And where do we invest to participate into interesting stories? We've put for you there the way our investments have been targeted internally. And it's interesting because what it shows is that it's affecting each and every segment of the insurance value chain in a significant way. The other things we've been putting there is the amounts we've been investing outside of the group to try to generate new ideas, disruptive models, sometimes purely outside of the group, and it's AXA Strategic Ventures, which has now completed approximately 17 investments in various startups. The second thing is at the borders of the group, Camet, which is led by Stéphane Guinet, the former head of the direct business, which is another interesting experience we started in the 90s, which is now generating billions of revenues. This is to build internally disruptive models. The last point is a quite interesting investment we've made in the recent weeks in AIG, not the insurance AIG, but Africa Internet Group, which is the Amazon of Africa, where we have invested in their equity, but also set up an exclusive distribution agreement for our insurance products to their clients. It's an illustration of the combination of new technologies and new geographies, which for the future should create additional growth. Last but not least, of course, we do that with a high consciousness of the fact that AXA is not only a balance sheet and a P&L, and we have moved on the corporate responsibility side. And I think some of the moves we've been making have been extremely good for the understanding and the reputation of the brand. We've been divesting from coal, as you know, because we don't think it's a good long-term investment. We are publishing our carbon footprint, which leads us to have a pretty strong ranking on the DJSI. We are well prepared for the future, and we will tell you more about that in June, because I think we can write now an interesting new page. We have a great mix of businesses, 25% protection and health, 40% property casualty, 36% or 35% savings and asset management, so 3 legs to walk. We have a very strong balance sheet. We are the #1 brand, which is great to attract talents, clients, and partners. And interestingly, even if it seems anecdotal, we've been ranked the most innovative insurance company by the 800 biggest clients of BCG, which I think is an illustration of the fact that people are taking seriously what we've been doing in new technologies. So this was just the introduction I wanted to make. As usual, Denis and Gérald are going to walk you through these earnings, which we think are pretty good earnings.
Thank you, Henri. Good afternoon, everyone. So we'll start, as usual, with the underlying earnings of the group. You see that on the life, they are up to 2% on the comparable basis and 9% on a nominal basis. Life and savings had very good results, plus 3% on a comparable basis to 3.5 billion euros. P&C is slightly down on the comparable basis by 1%, and I will comment on that further. Asset management up 1%. I will not comment in detail on the last 3 segments, which are smaller, but just to say that the net of the 3 is positive, and the biggest change is in the holdings segment, where the charge for interest rates has declined by roughly 60 million, partly offset by more investments in digital. Adjusted earnings were up 2% to 6,008 million euros on a comparable basis, plus 9% in nominal value. You see that the net realized capital gains were almost stable at 433 million euros, about the same amount of capital gains, the same amount of impairments, a good result of +2. Net income was up 3% at 5,617 million. The main comments are related to the change in fair value and forex. On interest rates, hedges not eligible for hedge accounting, we have a negative number of 158. On Forex, we have a slightly less positive number than last year at 141 million. And on the change in fair value of assets accounted for as fair value, so it's the essentially the bond funds which are fair value through the P&L. We have a minus 2.212 million, which relates to both a slight increase in interest rates during the period and a widening of interest rate spreads. On the exceptional and discontinued operations, we have the benefit of the capital gain done on the sale of our mandatory pension fund business in Hong Kong. Integration and restructuring costs are fairly stable. Intangible amortization is slightly negative, but much less than in 2014, where we took a hit on our Russian goodwill, as you will recall. Moving to the life and savings business. On the life savings business, we have a growth of our new business of 6% in mature markets, with a new business margin which is slightly down from 31 to 30%. The main, I think the main reason for that is probably coming from a slight dilution in the UK with a large sale of corporate tip, but it's not a big figure. High growth market is disappointing at a +1 in new business. It's really essentially because of a decline of our sales in Hong Kong. This is something that we had flagged a year ago. Hong Kong changed the regulation of regulation in terms of disclosure for unit-linked products, where all the charges and commissions had to be disclosed. The market stopped selling unit-linked altogether. We were the biggest seller of unit-linked. Our general account product was too capital intensive, and we didn't push for the sale of this general account. We had a shorter product that was redesigned in the spring but didn't sell as well as the competition. We have redesigned our product more in line with the competition. It's starting to sell in January, but we've lost time in Hong Kong and had a disappointing sales volume of -12. The rest of the high growth market were up 12%, much more in line with what we expect going forward. Overall, the margin moved from 49% to 51%, which is, I would say, a consolation. All in all, life new business sales were up 5% with a relatively flat margin of 34%. Looking now at the mix of business of our life sales, you see that protection sales were up 4%, margin relatively stable at 52%, net flows at 5.9 billion. GA savings down 7% in line with our strategy to focus on protection and health and unit linked. Margin at a high of 19. You have seen in one of the slides presented by Henri that 5 years ago the margin on that business was -1, which is a testimony to the change in the product design that we've achieved also in GA savings. Flows are negative at 2.4 billion. Unit linked sales up 12%, margin of 31. The flows have moved from 0.7 to plus 5.7. This is also due to the fact that last year we had a big buyout in the US, which we have an ongoing buyout in the US, but it's much smaller. So this has helped the net flows on the unit link side. All in all, 9.6 billion euros of net flows compared to 4 billion last year. From an earnings standpoint, the sales were the profits were up 3% overall. They were up 2% in protection and health, with a higher mortality margin in France and the US, partly offset by an accelerated amortization of DAC in the US. GA savings, we have a negative evolution of profit of 4%, with on one hand lower administrative expenses, which is good. On the other hand, lower investment margins and a change in annuitization assumptions in Japan. Unit-linked profits were up 10% thanks to higher fees and a better result from GMXB in the US, in spite of a reserve strengthening on our GMXB due to policyholder behavior in part essentially linked to the secondary effect of the buyouts. Moving to P&C, our volumes, our revenues were up 1%. They were up 2% in personal lines and flat in commercial lines. In both lines, we have a price effect which is quite substantial, 3.2% in personal lines, 2.4% in commercial. This price effect was more than offset by a volume effect, and we can see that in more detail on the next page, page A30, where you see the details of price effects and revenue growth by country and business line. A few points to highlight. You see that in the UK personal lines, we benefit from a 5.5% price effect, so a continuation of solid price increases in motor in particular. You see in France, on the commercial line side, a price effect of 4.4, which is essentially a function of the price increases that we've put in the construction line, which had losses consecutive to the economic crisis in France and a decline in construction volumes. In Med-LA, we had both significant price effect in the personal and commercial lines. And the price effect in personal lines is in particular linked to Turkey. In commercial lines, it's a little bit across the board. For 2016, we have given you some pricing trends. You see in green the UK. In yellow, you see most of the other territories. You see negatives in Switzerland and Belgium. We need to remind you that in both countries, we have combined ratios which are quite low, 86 in Switzerland and 91 from my recollection in Belgium. So we believe we can swallow that. Looking now at the evolution of our revenues and margins by markets. Revenues were flat in mature markets, with a combined ratio declining from 97.1 to 96.3 on a current year basis. High growth market revenues were up 3%, Asia up 8%, Turkey in particular flat. The current year combined ratio deteriorated from 98.7 to 100.9. If we exclude the impact of the current year reserve strengthening in Turkey or loss, I would say it's 99.4%. Maybe I comment on Turkey now. Turkey, we strengthened our reserves in total by 252 million euros, 57 for the current year and the balance for prior years. It's linked to a continued deterioration of the legislative environment for bodily injury. It's a story that has started back in 2012, but has continued to deteriorate this year with not only the retrospective application of the legislation, but also new legislation which was adverse. We believe that we've addressed the situation correctly, both from a reserving standpoint and from a pricing standpoint. If I compare the beginning of 15 and the end of 15, on motor third-party liability, we have more than doubled our prices. The full year effect on motor is only 18%, but from beginning to end of the year, we have more than doubled our prices. We believe that the market is seriously under reserve. We believe that in our consolidated account, we have fully adjusted our reserves and that we are reasonably well prepared for the future. Direct business is in good shape. We have increased our revenues by 7%, mostly in France, Japan, and the UK. Our combined ratio slightly improved to 99.3% on a current year basis. All in all, our current year combined ratio went down from 97.6 to 97.3%. Looking now at the full year earnings on P&C, minus 1% on a comparable basis. Combined ratio has improved from 96.9 to 96.2 on an all-year basis. You see three impact. The current year combined, as I mentioned, down 0.3 points. The impact within that of natural catastrophes was modest this year, 0.6%. Essentially, some storms in Germany and floods in France, but it's lower than our normalized Nat Cat charge, which is around 1%, whereas it was higher the previous year. Prior year reserve developments are slightly more favorable at 1%. All in all, we end up at 96.2. If we were to exclude the impact of reserve strengthening in Turkey on one hand and normalize the Nat Cat level to 1%, we would have ended up at 95.6%. We take a hit on investment income, which is down 8%. We had an investment yield of 3.6 against 3.9 in 14. It was exceptionally high in 14. So normalized, it would probably have been more 3.7, 3.8. But still, we have a decline in investment yield, which had to be expected. Moving to asset management. We had a good year in asset management overall, particularly at AXA Investment Managers, where the net flows were 42 billion euros, of which 34 billion in our Asian JVs, the bulk of that being with our Chinese JV called AXA SPDB, with Shanghai Pudong Development Bank. Within that JV, we continue to see very strong inflows, even post the equity market crisis. We had negative flows in July and August, but we resumed the positive flows as early as September. We are considered the best equity manager in China. The non-JV business also had a good year because the non-JV flows moved from 4 billion in 14 to 8 billion in 15. Average AUM for AXA IM, excluding joint ventures, are up 7%, and revenues up 4%, excluding joint ventures, because we are not consolidating them. Net flows on AB were more modest, 3 billion euros positive. Average AUM up 3%, and revenues flat on a comparable basis, but significantly up on a euro basis. For the underlying earnings, they were up 1% on a comparable basis in asset management, 5 at AXA IM, and -2 on a comparable basis for AB. I'll hand over now to Gérald. Thank you very much for your attention.
Good afternoon. So, as far as ALM is concerned, our invested assets amounted to 552 billion. You can notice that, as in the past, the vast majority of our assets, 83%, are fixed income assets. And real estate corresponds to 5%, listed equities 4%, and other income, mostly loans and ABS, represent 7%. The duration of our assets is pretty long, 8 years for life and savings, 5 years for P&C, so we kept a tight duration mismatch, which is good in this environment where rates are going down. And the asset yield continue to hold quite well. In life as well as P&C, you can notice in P&C that it goes down from 3.9 to 3.6, but as Denis just told you, excluding an exceptional dividend in 14, we would have been at 3.8. Let's focus now more on the fixed income side. And first of all, starting on the left with the govies and the related bonds, which are maintained in a AA range. And whereas on the right-hand side, you have the corporate bonds rating, which is corresponding to 190 billion, still in the single A range. And of course, you will note also that we have 8% invested in below investment grade. Below investment grade is roughly 19 billion at the group level, but it's mostly, the vast majority is very short-term high yield, which has much more visibility. By short-term, I mean between 1.5 and 2 years. You will see more detail in the appendices, and if you have more questions, of course, I'll be quite happy to discuss it during the Q&A. Let's focus now on the 2015 investment. We have been investing 65 billion at an average rate of 2.1%. And you will see that we have been invested in investment grade credit for 57% with an average rating of single A. Govies, because you know that the way for us to manage our duration, the only way to manage long duration is through Govies, because the duration of corporate bonds is shorter. Below investment grade, 12%. That's the same comment, mostly in short-term high-yield bonds between 1.5 and 2 years. Let's have a look at the investment margin. The investment margin was quite resilient. It dropped from 80 to 79 basis points. This is mostly explained by the spread of the guaranteed rate on the in-force book, because with an earning yield at 3.6, we have a guaranteed rate at 2. 1 year ago, it was 2.1, which means that we have a margin of 160 bips. On the new business, it's the same. That means that we are investing at 2.1. The average guaranteed rate is 0.5, which means that we have an average spread of 160 bips. Let's have a look now at the shareholders' equity. The shareholders' equity went up from 65.2 to 68.5, mostly explained, I would say, by 4 elements. The first one is, by definition, net income of the year, 5.6 billion. Next is a dividend, the dividend 95 cents that we paid 1 year ago, that we paid in May last year, corresponding to 2.3 billion. Next is the change in net unrealized capital gains, mostly coming from the widening of the spreads and slightly higher rates, minus 2.6, and the forex movement. I remind you that it's worth noting that our FX hedging policy is to protect up to 25% of our shareholders' equity, meaning that we benefited from a higher dollar, a higher Swiss franc, and a higher pound. Next is the debt. I would say that, as already mentioned, we have a debt gearing which is at 23%, which is in the low end of our range, which was 23 to 25%. The interest coverage went up to 10.7 times. Most of our debt are subordinated debt. You can see 9.5 billion undated sub-debt, tier 1 debt, and tier 2 debt, 6.9. We remind you that our rating are now single A plus positive outlook for S&P and AA minus or equivalent at Moody's and Fitch. Moving to Solvency II. Solvency II ratio is at 205. And you can see here on the right the sensitivity of the Solvency II ratio, which is more or less in line with what we had been sharing with you in our R Day at the beginning of December. Since we starting from 212, which indeed that we shared with you at the IR Day, the evolution, the roll forward is quite straightforward. You have the operating return of the last quarter, plus 5 points, minus the dividend, corresponding to minus 9 points. In the end, we are at 2. We end up at 205. Let's move to the group EV. So the group EV had been adjusted in order to take into account the cost of capital of Solvency II, which is a plus of 0.5 billion, which is not in the operating return. Nevertheless, the operating return is quite strong at plus 18%, in line with our earnings and NBV growth. And we end up with a group EV at 51.2 billion. Let's move to the operating free cash flow. The operating free cash flow in 2014 was in life 2.5 billion. In 2015, on a pro forma basis, it's 3.1 billion. taking into account the fact that we have a higher cash flow of 0.5 billion coming from the lower cash requirement. As you know, under Solvency II, we can benefit from the future profit just to match the capital requirement. The story is the same with internal rate of return. Our internal rate of return went up from 14.2 to 14.4 under the Solvency I framework. In Solvency II, it's 17.5, so higher for the same reason as the one I explained for the life cash flows. Next is the global cash flow, I would say, and the cash flow combining life and the other business lines went up from 5.5 to 5.8, plus 5%. And the remittance ratio went up from 86 to 87. In the end, we had 5.1 billion upstream to the holding company. And as you can see here, the part coming from the US was in line with what we said, 0.6 billion. On a pro forma basis, it's the same stories. That means that it would have been, the global cash flow would have been 0.5 billion higher due to the lower capital constraints. Last, I would like to share with you the sensitivities to market conditions. We did the same 1 year ago. And assuming that we would invest at 2% on average, we were at 2.1 last year, so 2% on average, it means that we would have an impact of 0.2 billion that would be recurring, assuming that we would still invest in the future years at 2%. In case we would invest at 2.4, then it would be a hit of 0.1 billion only. As you know, we already had such an impact of minus 0.2 in our 15 accounts. Limited equity sensitivity, because if we would have a 10% decline in our equity, in the equity market, the net impact on earnings coming mostly from the fees from unit-linked business would be down 0.1 billion. Last, Solvency II ratio that estimated these days, that means yesterday, it would be circa 190. How do we explain this drop of 15 points? I would say minus 8 points coming from the rates and from the fact that we had a decline between 40 and 50 bips, depending on the currency. We had a slight decline coming from the equity, assuming a 10% equity, it's minus 2 points, so as a whole it's 10. And on top, we have the volatility, and the volatility on both equity and interest rates went up, which explains an additional minus 0.6. In this 190, we didn't take into account the operating return for the almost 2 months of the year. I hand over to Henri for the conclusion.
Thanks, Gerald. This conclusion is going to be a very brief one. Strong earnings, strong platform, interesting future. Now, questions. So, let's start. Maybe when you ask your question, if you can say who you are, not that we don't know you, we know all of you, but for the people who are just listening to the presentation, it's probably more helpful. Is there a mic somewhere? If you could come in front, thank you.
Thanks. It's James Shuck from UBS. I had 3 questions, if I may. Firstly, just thinking about the development of the AFR. I appreciate it's new disclosure that we're moving through with Solvency II, but I'm interested to get a feel for the kind of natural organic capital generation as into 2016. Because it's one thing to look at your capital generation as you can on a cash flow basis, and it's another thing to think about certain drag effects that there might be, such as the unwind of the volatility adjuster, for example. So if you could just talk through how we should think about the AFR development in 2016, that'd be helpful. My second question is around the Tier 1 capital. I mean, I think when you showed the Solvency II Investor Day, you gave some excellent disclosure that was very helpful. I think you had 84% was shown as Tier 1 capital. I'd just like a bit more insight into the components of that Tier 1 capital. If I was to take the in-force value from the MCEV disclosure, is that a good proxy for the amount of in-force that's actually included within Tier 1? That's my second question. And then if I can quickly steal a third one, it was just on the new money yield. I'm just interested to know, you were 2.1% in 2015, but what is that if we're to sort of think about the first quarter of this year? And are you seeing any problems about actually finding liquidity and investing in corporate bonds?
Okay. Gérald, do you want to take these questions?
Yes, about the development of AFR. You remember that at the beginning of December, we mentioned that on average we could expect to have an operational capital generation of 20 points. Net of dividend, let's say of 10 points, it would mean roughly 11 points. But this is, I would say, on average. And for sure, as far as the AFR is concerned, it goes along with it will evolve with the mark-to-market, and that's the reason why I said that we would move from 205 to 190. So. On an instantaneous, on today's basis, roughly we would be slightly above 190, let's say. You can expect to have an accretion of, let's say, 10 points. You should deduct from these 10 points, that's a point that I mentioned, the acquisitions, when we make some external acquisitions. I remember that I took the example of imagine that it would be 1 billion. 1 billion in a high growth countries, it's minus 6 points. In mature, it's minus 3 points. So I believe with these elements, and don't take the 1 billion as a kind of forecast, it's just an example, but it gives you an idea of this sensitivity. Your second question was about the Tier 1 capital and the MCEV. So in the EV report, but we can also take it offline. But in the EV report, you have a reconciliation, and if you go to go to page 27, and here you have a reconciliation between IFRS shareholders' equity and the group AFR. So you first you have the shareholders' equity. That's quite classical. You deduct all the TSS, TSDI. You deduct then the excluded intangibles. That's quite customary. That's the way we have been presenting it up to now. And you have the TNAV, which is at 32.3 billion, and then you add the VIF, and you end up with an EV of 51.2. Next, you have the dividend to be paid. You add the TSS, TSDI, Tier 1, Tier 2, because they are part of the numerator of the Solvency II ratio. And you have some technical adjustment. Among these minus 5.9, you have two main elements. One corresponds to the MVM, to the market value margin, which is quite significant. And you have also the move from the actual P&C reserve to the Solvency II reserve. So that's mostly it. But I can comment further after the meeting with you if you have additional questions. So your last question was about about the investment. Today we are under the present condition. We are investing roughly between 2 and 2.1%. Which is nevertheless not so easy, but we don't give up on the quality. You notice that we have been quite firm on the fact that we were investing in, as far as the sovereign bonds are concerned, on average in AA, single A in corporate bonds. So it's not so easy. The liquidity is not so high, but we achieve it. Don't miss also that we can invest in other type of assets like ABS, like CLOs, but high quality CLOs, AA+, but it's illiquid and we can get some higher returns, as well as in loans like corporate real estate loans. So we are using different ways in order, while giving up some part of the liquidity, not giving up the quality. Keep in mind that when we invest in triple B minus, for example, bonds, if there is a downgrading, then immediately the cost of capital would be much, much higher. So that's why we are extremely cautious on that side.
Go ahead.
I had a couple of niggly questions, I beg your pardon. The first one is on the cash. So you had this increase in net of cash from 5.5 to 5.8 billion. Last year, I remember you remitted a figure I had in mind of, I never know which currency, but call it US dollars, 1 billion. This year, I think you remitted $800 million. And I just wondered why you left $200 million in the US. I mean, I was joking with your lovely IR team, and I said I'd be like Oncle Picsou, I'd take a bath in gold doubloons every day. I wouldn't leave anything in the US. So that's really, I just wondered, is there, to understand this, I don't think that it's. The other thing is, I noticed, and it's again a really stupid question, there's quite a big rise this year in your deferred acquisition costs. So last year they went up 2 billion, this year they went up 3 billion. So that's, and one day these things have to be amortized or written off. So I always wonder a little bit about that. And then the final point is, can you look us in the eye and say Turkey is finished? That'd be really nice. Thank you.
I will take the Turkish question and leave the other two for Gerald. So, I probably told you in 2012 when we take the first big hit that Turkey was finished. This was without knowing what the regulators, what the judges and the legislator would do in the meantime. Right now, I can tell you that we have taken a hit that we believe is reasonable, is way more significant than our competitors. But there are still a number of assumptions here. The hit is IBNRs, so we are basing our reserve estimates on an ultimate, what we believe is the ultimate development of those claims, and we are making certain assumptions on the likelihood of a litigation by the victims of accidents of the last 10 years. And this percentage of claimants has increased steadily. We've made our own estimates of where it would peak. The peak that we have estimated is not 100%, so we may be proven wrong, but it's quite high. And so there are lots of estimates like this that come into account. But among the last developments that have taken place, there was an indemnity for the liable driver that didn't exist. There was a compensation for the loss of value, which is something that exists in Germany but in no other place. And will there be further surprises? I don't believe, because we believe that if people were putting their reserves if the rest of the market were putting their reserves where we have put our reserves, there would be no equity left in the P&C market in Turkey. So there will be some time for adjustments of capital with our competitors.
The only good news is that we have the feeling that following the lobbying efforts, the Turkish supervisors and regulators have finally understood that the insurers were not the Alibaba cavern. Gerald.
First of all, about the US. In the US, we don't pile up the cash in the US. You know that we mentioned last time that we would upstream between 0.6 and 1 billion euros. That's what we did, and I can tell you that we still have 4.3 billion debt left in the US, a loan from the holding company to the US. We will maintain the same type of amount. We can expect to have between 0.6 and 1 billion euros that will be upstreamed to the holding company. So no specific worry on that side. And the stories that we told you last time is still true today.
There is a positive regulatory development on that front, which is that the New York State was allowing the lower of 10% of surplus and the statutory earnings as an upstream, automatic upstream, and now it's the higher of the two that works. So for it will allow us to increase the dividend that doesn't have to go through the regulatory gate, and that should come sometime this year.
On the DAX?
On the DAC, so I believe that your remark is mostly relative to the US. The DAC increased from 11.4 billion, from 10 billion to 10.9 billion after tax. So that means that this DAC level has been increased mostly due to the significant part of it is explained by the lapse. You know that as explained by Denis, we have increased our reserves to take into account the lapse rate, which is lower than expected. Same for what we call the partial withdrawal. So the impact has been roughly 350 million euros of additional DAC. But pay attention to one point, which is the DAC in itself should be analyzed in the light of the K factor. And our K factor went down because why? Because when you have more lapses, less lapses, that means that you will have more future profits, more future fees, which means that if I take on the last year we had a K factor at 65%, and this year we were at 58%. Another way to look at it, if you go into the EV report, you will notice that in the end, the impact on this reinforcement of reserves was only 75 million euros negative. You have a footnote on this.
Okay, go ahead. Let's change side for a while.
Thank you. It's John Hocking from Morgan Stanley. I've got three questions, please. I wondered, firstly, if you could talk a little bit about claims inflation in P&C and how that's comparing with the rate you're achieving on the book, both in the commercial and personal. Secondly, on the high yield, I realize it's very short dated, but it superficially sounds quite scary being in the high yield market at the moment. I wonder if you could talk a little bit about the confidence you've got on visibility, which sectors you're in, and just give a little bit of colour around that high yield exposure, please. And then just finally, just on the slide you put up with the sort of capital stack, the cash you're netting off there, is that the holding company cash? Because it's gone down quite a lot year on year. It's from 4 billion down to 2.8. Is that not a holding company number? Is it a different cash balance? Thank you.
Go ahead, Gerald.
On the first point on the claims inflation, so you have an appendix on this. That's, let me find it, and yes, that's on page B39. B39. Thank you, Dan. On B39, so you can notice that on the total P&C, we had frequency and severity, which increased our combined ratio, and it was severity is 2.1, but of which you have the impact of severity of Turkey. So and Turkey is roughly one full point. So that's why we have a severity of +1 point, which is more than offset by a price effect of -1.5. What is the good news is the fact that we have a frequency which is still negative at a -0.8. And so that's I remember that 1 year ago, a lot of you had questions about the fear that that frequency would go up. It's not the case at all, and we don't see for the time being any rise of frequency. Your second question was about was relative to high yield, and as far as high yield is concerned, we don't have. I know that there are a lot of questions and legitimate questions about high yield and the impact of oil on high yield, and I believe it's your question. We have an appendix on oil and on our exposure to oil and gas. It's our exposure to oil and gas as a whole is 12 billion only, and it's this 12 billion. Out of this 12 billion, the share of corresponding to
B48 and 49.
48 and 49. I have always difficulties to find my pages. So on on page B48, you can notice that we have 12.1 billion invested in oil and gas, of which investment grade is only 8%. So you below investment grade is only 8%. Thank you, Daniel. I didn't want you to have a wrong assessment of the way we manage our assets. So below investment grade being 8% only out of 12 billion means that we are quite safe, and we don't believe there is any risk. And going back to the previous question I answered, look at the BBB minus, it's 9% only, and that's what we have a close look at this. Just a general comment about the way we manage our corporate bond risks. We have a group credit team which is independent from the two group asset managers, which assess all the risk. They cover 80% globally of our corporate bond exposure, and so that means that on a regular basis we are assessing the risk. We have our own ratings. It's part of our Solvency II, I would say, framework. That means that we have our own view on each type of risk, and that's why we have been for a long time now extremely cautious on managing and anticipating these downgrades.
And one comment on this below investment grade portfolio. It's essentially, as you said, short duration high yield, and this short duration high yield portfolio is essentially managed by an AXA investment managers team based in Greenwich, Connecticut, with a duration that is lower than 2 years, and an extremely good track record that they've maintained through the various cycles, and we are quite confident with that.
Just as an indication, what is the sort of new money yield if you're investing in high yield today? What sort of spread are you getting on it?
Roughly speaking, we can invest at a level which is 3.5%, roughly, under today's. Yeah. Your last question was about the cash in the holding company, in the holding. Yeah. Yes, and maybe we can go to page B76 because it's. On page B76, you can notice that up to now we have been reporting our debt level, which was a net of cash basis, and that's what you see here. We were at 23%. That's what I reported. But a new methodology, we will apply a new methodology. Why? Because we believe that it's much more in line with the global practice. For you, it should be far easier to compare ourselves with our peers. And for us, it will be also easier because it's the way most of the rating agencies are reporting the debt gearing. So that's what I wanted to. So we will start in 16 reporting this way.
Okay, go ahead, Farooq.
Hi there, Farooq Kenny from Citigroup. Even if you add back some of the one-offs, Turkey, reserving in the US, your underlying growth rate in underlying earnings is still between 2% and 3%. So it's a low number compared to what you've achieved, obviously historically with markets, FX, and all the tailwinds. So should we think of you now going forward as a company that just needs to supplement a low level of organic growth with M&A, but with attractive cash? Is that how you'd like us to view you? That's kind of question stroke comment number one. And the second point is, the more I look at the US business, you seem to talk about it less. You're talking about high growth markets. You know, it's never central to your strategy and view. And the VA market, I think, is about to see a big change in the US. You know, probably this year with the DOL regulation. Isn't it time that, you know, I mean, would you ever consider exiting the US?
No.
Thank you.
No, I mean, it's not, I mean, we are trying to focus on the elements which are noticeable, I mean, the US had a strong and a good year. Strategically, I think it's important for a group like us to be in the US because structurally the US economy has a potential growth rate which is higher than Europe. So I see no reason for us to exit the US. Yes, sometimes you have headwinds. We've had some of them in the past, but there is absolutely no strategic reasons to exit the US. I mean, on the contrary, I think we have a very solid basis to build from. As you know, we've been starting some initiatives on the employee benefit field. We think there is room to grow. We have a very strong team. We have a very strong team there. Go ahead. Go ahead. No, go ahead. Go ahead.
So on the US, yes, we have the cloud of the DOL, which applies not just to AXA, but to the totality of the market. But we have a number of growth initiatives, and when you look at the trajectory of growth of our US earnings over the last 5 years, I wouldn't say that we are ashamed of this trajectory. So we are quite confident in the quality of our US business, the quality of our US teams, and we have a solid growth trajectory. B34, yeah, okay.
Yep.
Thank you, Gerald. So B34, you see that we've moved from under 500 million euros of earnings to 850 this year. So we are not worried about our ability to keep some growth in our US earnings. Coming back to your more general comments on low underlying earnings growth, I mean, we've not been shy of telling you that low interest rates were a permanent 200 million euro headwind at the current level, which means that we need to offset this minus 4 points roughly of underlying EPS growth by our various growth initiatives. I will not give you in February the June presentation. We still believe that we have the ability to grow organically this business. You see that our life growth was quite, in terms of earnings, was quite good. We've had some negatives in P&C this year, but we have a number of initiatives to grow our commercial lines business. This was part of our Ambition AXA priorities to grow the commercial lines business. We've not been totally successful, but we've worked a lot in the meantime, and we believe that it will come eventually. Our asset management business is reasonably well positioned, so we do believe that we'll be able to grow organically. M&A will add on top of that, but we believe that we'll be able to grow organically.
So wait until June, and you will see.
But between now and June, you know, it's, look, you can do better than that, but we just have to wait for what those initiatives are.
Okay. Yes.
Yep.
Thanks very much. It's Blair Stewart from BofA Merrill. Just a couple on the US. Just sticking with the DOL, have you refined your thoughts as to what might happen there, and how do you see the product evolving in the US? It strikes me that either there'll be lower volumes and therefore there'll be possibly better cash flows for you because you invest quite a lot in terms of new business strain, or the product will evolve to be less capital intensive from the outset if the market moves to a fee-based structure. So how do you see the US evolving with regards to the product and what impact the DOL might have? And sticking to the US, the reserving change that you've made for experience, is the reserving now in line with current experience, or is there still some gap, plus or minus? I've got a further question on cost, but maybe we can do the US first.
Denis, do you want to take the two questions?
Yes. So reserving change for experience is now completely reserving change. Sorry for lapses and for partial withdrawals is fully in line with the current experience. DOL, I wouldn't say that we have more clarity now on the DOL, other than that we know that probably in April the new rule will be published with an application roughly at year end. That's about all we know. I think the people are really waking up to this, because a number of people thought that their lobbying would be effective, and now they realize that it has not been fully effective. But there is still a lot of uncertainty in terms of whether the various firms will allow their distributors to provide advice and take additional legal risk. And what I heard in the US a few weeks ago was that probably large firms would be forced to accept that their distributors take that responsibility, because it will be a competitive advantage to do it and a competitive disadvantage not to do it. So, so basically, that's. I mean, this. I think there will be as much news coming from the behavior of the firms and their advisors as from the rule itself. And until we have more clarity on that, it's very difficult to anticipate the impact.
What's AXA's thoughts around advice?
Again, we will look at the potential impact and also react to what the competition is doing. But this is clearly a very important topic, and I believe that the US market is quite competitive. I mean, advisors are quite mobile, and we need to take that into account in our thought process.
What about move to fee-based?
The move to fee-based is only going to apply to the high end of the market. We've seen that we've seen that in the UK. I don't believe that for the I would say the mass affluent client base, which is our client base, the vast majority of people will be sold on fee-based products.
Okay. Next question on this side this time. Sorry, we'll come back.
Thank you very much.
Nick.
Nick Holmes at SocGen. Couple of questions, this time on the P&C business. Firstly, your target combined ratio of 96%. Wondered if you could give us a little bit of colour as to what you think the environment will permit you to target going forward. To be more direct, can you beat 96% going forward? And then second question, sort of related, is on the Turkish experience. How does this influence your plans to expand in new markets, particularly direct? I think Asia direct P&C is a big focus for you. Does the Turkish experience make you think that it's more difficult to do that? Thank you.
I mean, I would say on the first question, be a little bit patient and wait for June. I mean, there are a number of markets where we are below 96. One of the reasons for which we are still at these levels is also that in a number of countries we are still in a development mode on the direct side, which over time should see improving combined ratios. On the Turkish experience, I would go beyond that. I mean, we've had some disappointing experiences in Eastern Europe as an example. I think one of the issues each and every business is faced to with emerging countries is that the BRICS and the Mint, all these emerging countries, they are now faced to a sort of implicit ceiling, which is a poor quality of their public governance. And yes, it's a concern, but it goes with the risk premium. We know that we have to accept a certain degree of risk. We are there for the long term. When you look at the Turkish economy, beyond Mr. Erdogan, it remains one of the vastly populated markets of the region. It remains a very strong economy. Yes, you will have phases where there, as well as in other markets, you will see adverse regulation, adverse governments, bad surprises. But in the long term, I think it's still worth doing things there. Because if you don't do that, the risk you take middle term is to cut yourself from the most rapid emerging consumer class which you want to target. It's not as if the middle affluent middle class was growing by tens of millions in the mature countries. We know that there is a challenge in the mature countries. The place where wealth is going to be created, even if there are going to be ups and downs around the trend, remains the emerging world. So we have to target very selectively what we want to do. And if you look at what we've been doing, we've been selecting the large markets. We have to accept the fact that you'll have some bad surprises. Fine. But I think it's worth the trip in the long run because you build the brand, you build the client base, and over time, things are probably going to normalize.
And maybe a few additional points. I mean, if we look at it from the inside in terms of the lessons that we've drawn, both from what happened in Mexico last year with the big hurricane and what happened in Turkey repeatedly, I think we've taken a number of lessons for the way we manage our portfolios. Reserving sophistication, claims management sophistication, pricing sophistication, more diversification of the book, less motor exposure, and better mix of motor and commercial lines, and reinsurance. We've lowered our the trigger points of our reinsurance compared to what we do in mature markets because we realize that we don't have an as sophisticated understanding of each of our exposures.
Yeah, I mean, the place where populism is taking place, because bad regulation is most of the time coming from populism. It's more retail lines than commercial lines, which leads us to think that, I mean, if there is an area where you want to develop faster, it's probably commercial lines going forward. Next question.
I just take it. It's Ralph Hepkin from KBW. Two things. One relates to the VA reserve increase, because I also noticed that you announced another buyback program in the US. And I was just wondering whether we could explore to which extent that reserve increase may have been related to the anticipated change in policyholder behavior, which you sort of perhaps yourself created through announcing the buyback, because the buyback itself will certainly change that and have an effect on lapse rates. And the second one, that was such a complicated question, I forgot my second one. The second one relates to the volatility adjuster and the Solvency II ratio. This is also quite technical, but are there, to make this simple, are there any limits to which you can make applicable the dynamic volatility adjustment at a time of heightened market volatility? Is there basically a limit beyond which you will not be able to neutralize the impact of increasing spreads? Thank you.
Denis, do you want to take the first and Gerald the second?
Yes. I take the first question on the US VAs. In a sense, you are right. I mean, I mentioned the relation between the buybacks and the reserve increases linked to changing policyholder behavior. The buybacks in themselves have triggered lower lapses, and I would say that the buyback that is currently taking place has a much more limited impact in terms of take-up. The previous ones had the take-up of roughly 12, slightly more than 12%. This one will have probably an impact of roughly something like a take-up of something like 4%. So the reserve adjustments are more a function of the previous buybacks than they are a function of this one, which is much more limited in its impact. But clearly, we have taken the opportunity of the buyback, which are a good guy, if you want, by adjusting the reserves, taking into account our current experience in terms of our policyholder behavior.
Gerald, on the volatility,
yes.
The limit to the absorption.
Yes. First of all, I remind you that we have a low sensitivity to corporate spread for one reason, which is mainly the fact that the volatility adjuster is done for all it's an average of different companies in Europe, and we have a percentage of sovereign bonds which is higher than the model portfolio. To answer directly your question, the volatility adjuster has been done and has been created at the demand of all the industry just in order to offset these movements. Why? Because it's not because, of course, if the corporate spreads widening would mean or anticipate any kind of default, then the default would be in your accounts. But so long as it's just a matter of volatility on a mark-to-market basis, it will be offset, and the objective is really to adjust the discount rate used to discount your liabilities. So I don't think so. And look, at the time, we should think about Solvency II. It's the first year of implementation. There is no real intent to change it, and keep in mind that you have plenty of companies today who are using the transitionals because they did not move to Solvency II. So first, apply, it would be important to be sure that all the companies move to Solvency II, and next, to think about any kind of revision. But to be clear, for the time being, there is no sign of any kind of revision as far as the volatility adjuster is concerned. It's part of our internal model. It's been validated like this.
Andrew? Yeah, or I mean, whoever on this side.
Hi, it's Fahad Shingazi from Nomura. Could I just ask a question on big data and technology? Everyone is doing it. And sorry to be provocative, but should we be taking this seriously? And what kind of metrics or indicators are you looking at that will lead some tangible gains later on, or are you just running to standstill? And the second question on commercial, I don't want to preempt the June Investor Day, but UK commercial still remains very competitive, and also the rest of commercial. Just talk about general market conditions and if there's been any impact from Zurich's troubles. Thanks.
On UK commercial, since Paul is here, I'll just ask him to briefly comment on the very remarkable performance we've had over the last 5 years, and on the reasons for which we think that we are in a very good position going forward.
Microphone.
Come.
Yes, so the rates are challenging in commercial. I think we probably saw an overall rate movement of around -1% in the UK SME segment last year. But it's still possible to get growth through being closer to brokers, growth through being more digital in our engagement with both our customers and with our brokers. Over the past 5 years in the commercial segment, we've grown by about 8% compound each year, and that's come through very real tangible growth, i.e. more customers through more brokers. And I think that is sustainable going forward. You asked if the Zurich situation would create any change in the rating environment. I'm perfectly honest with you, I don't believe so. I think there is a general pruning that will go on probably in the larger risk segment of the market, not really in the SME segment. But will that in its own right address what is a sharp softening in the larger segment? I don't think so. That's more structural, that's hedge fund capital coming in. I think it's going to take a much bigger shock to address that. But I think we can have a degree of optimism, actually, that in a mature market like the UK, that we've grown by 7% in this past year, that we can maintain growth, not by being cheaper, but actually by being better for our customers and our brokers. I think we've demonstrated that over the past year.
See, on big data, of course, you should take that extremely seriously. Why so? Because I mean, in insurance, underwriting and customer understanding is all about capturing data points which are enabling you to map what the risk is. And to map it not only on a historical basis, as we did it in the past, but sometimes on a dynamic basis. So the ability to accumulate more information and sometimes to have this information real time is going to very, very profoundly change the underwriting, meaning the risk selection, the pricing, the prevention. And I'm convinced that over 5 to 10 years, the value added of the business is going to move from efficient claims settlement to efficient prevention. So it's going to change a number of things. I'll give you a very, very simple example. One of our issues in the French business was to have a 360 customer understanding, because the group is, as you all know, the result of an empilement of acquisitions, and we had in France 17 different databases. What we've been doing with some external help in mapping the, I would say the customer and trying to get to 360, thanks to big data, has enabled us to understand way better who were our customers, what was the connection between them. By the way, has helped us to identify a significant number of orphan clients. And you know that orphan clients can be an issue from a regulatory standpoint. So it's becoming real. It's not because it's real that it's not going to be gradual, but it's really becoming real. I mean, in large risks, you'll have a lot of things going on. Because in sophisticated machines, when you'll have chips on the machines, you will be able to detect much earlier what are the risks of disruption or of, breakup. And therefore, if you do it properly and if you have your customers accept to share some of the data with you, you'll be in a position to price better, to minimize the minimize the level of the claims. So we take it extremely seriously. If not, we wouldn't be making the investments we've been making. Andrew?
Good afternoon, it's Andrew Green at Autonomous. 3 questions. Firstly, your impairment.
It seems that everybody has 3 questions this afternoon.
It's quite a big company. It does a lot of things.
That's why we are 3.
On the impairments, which were 278 million last year, could you split that between fixed interest and other, and say whether you think, given the market turbulence this year, that you can still stay within the 300 to 500 million realised gains target? Secondly, you always quote this figure on the life side of your life portfolio yields 3.6%, and I think the guarantees are at 2%, and therefore the spread is protected. But those averages always hide potential rocks just sitting slightly below the surface, which we can't see. I wonder whether you could give us some sense and projection, maybe not now, as to whether you can really genuinely maintain that spread, or whether there are rocks which may upset it. And then thirdly, we've had sort of RDR come in the UK. We're likely to get it to come in the US through DOL. We have got a similar thing running through MiFID II in Europe coming up. How do you see that impacting your business?
Okay. Gerald, do you want to answer on the impairments and on the spread? Okay, and you take that.
Let's say that the impairment is mostly on equities, and we had almost no impairment on fixed interest. About your second question, which is what?
160.
Yes, I could say that today, if you have a look at our document, we said that the net unrealized gains on the equity portfolio was 1.7 billion, i.e. 1.7 billion after tax and after PB. Meaning that if I update this portfolio under today's condition, just the way we did it for the solvency, we would be slightly above 1. So which is a good outcome. Why? Because we were almost not invested in banks and in oil, which means that our portfolio behaved quite well. So we have presently a bit more than 1 billion of unrealized capital gains. Under the present condition, as a conclusion, we could say that yes, we maintain the 300 to 500. Of course, I cannot say what will be the evolution of the markets, but under today's condition, yes.
On the second question on the investment spreads, as you know, we disclose not only the fact that we had 79 basis points this year against 80 last year, and we have, as you said, the 2% guaranteed rate and the 0.5% guaranteed rate on the new business, and the 3.6 and the 2.1. The current yield and the yield on the new investments. We also disclose on page B65 the situation for the main countries, the main geographies, and you can see on that page that we are closer. The spread is much tighter in countries like Germany. Having said that, so we are still confident for 2016. We should be able to remain within that 70 to 80 basis points. If rates continue to stay very low for longer, we would probably have a gradual compression, but of a few basis points each year, but our projections 5 years out are still quite decent. So we don't expect to hit a wall in that space. Your last question is on.
Sorry, could I see what is your projection 5 years out?
We'll talk about that later, in June.
Do you want to take the last question?
The last question was: is there anything like the doll happening in Europe? With MiFID II, with PRIPS and so on. We believe it will not be massive and nothing like the DOL, in the sense that in the EU regulation is not prohibiting upfront commissions. I mean, we have the UK obviously situation, but apart from the UK, I don't believe that upfront commissions will be disallowed, and there is going to be, because of the low interest rate environment, a pressure on margins, both on the asset management side and on the life side, which we have to continue to address with expense efficiencies. And the one thing that we've said probably already 1 or 2 years ago was that we would have another expense efficiency program as part of our next plan, but we don't see a DOL-like situation coming up in Europe.
Yeah, and more generally, Andrew, I mean, we all know that there is a pressure in favor of the consumer. That's natural. If you want to see it in a negative way, you say it's an obstacle to business. If you want to create an opportunity with that, what it leads you to is to invest more in compliance, to protect yourself from risks, which I think we've done pretty efficiently so far. And if you look in the middle to long term, I would say the more stringent the regulations are, the higher the obstacle to small to middle-sized companies, which are not going to have the means to invest in the proper systems and in I would say the proper compliance. So for us, it's not at the end of the day necessarily a negative. Yep.
Thanks. Peter Elliott from Kepler Cheuvreux. I was wondering if you could give us an update on your in-force management. You gave us a very good presentation at the end of 2014 when you said you'd gone sort of 10% of the way through the book. So there was a lot more you could do in 2015, and you were targeting, I think, 400 million to underlying earnings from that. I was just wondering, if we could have an update and perhaps if there's anything more we can expect there.
Good. Gerald is a great fan of in-force management.
No, I would say that for sure we are on track, and we are moving forward on this in-force management. I take this opportunity to say that the in-force management is quite important for products which are extremely capital consuming, and that's the way we presented it, and we will do the plans that we presented to you. What is important to understand as well is that progressively we will move as well with Solvency II and with the emergence of Solvency II to capital light type of products, and by this I mean products where, for example, you don't have every year a kind of guarantee, but a guarantee in fine after 7 years, after 8 years, which is relatively which has a relatively good profitability under Solvency II. So progressively we can imagine also to replace some of the old products by this generation of products in an environment where you cannot imagine to sell exclusively unit-linked products.
Could I just follow up very quickly? I mean, some of that is sort of medium to longer term, but and I guess given all your comments on the capital intensive, I guess I was sort of looking at the progression of the GA savings result here and just wondering, what we can expect in the nearer term.
On the GA savings, and you have appendices on this that we could comment. So that means that on the GA savings we have a contribution which is slightly negative in terms of earnings. So we decreased slightly the GA savings contribution. We can go to the maybe if we have we can go to the appendices at the beginning on page
B20. B25.
B20. No, we can go to no B20. Let's go to B2032. And on page B32, this explains the margin on GA savings, and you can see that on a pre-tax underlying earnings basis, we dropped by we had a drop of 38 million. More or less, it was the same last year. And you can notice that it's mostly due to the erosion of the investment margin, which was minus 35 million. So we could say that through the margin on revenues and the technical margin, it's a wash, but it's mostly the investment margin which is going down. And this is pretty in line with what we did last year, and it's gradual, you know. And if you take the APE was minus 7%, so that's also something which is quite that we can expect, except the development, the potential development of these new capital light type of products.
Good. Still, one question in the front.
You mentioned you'd sold 2 big buildings in New York.
Yeah.
And it's a big gain, right? It's billions, a huge amount of money.
What are we going to do with the money?
Yeah, exactly.
Run. Run.
We'll
tell you.
We'll bring it back.
But can it be used for the dividend?
One thing at a time, Michael.
Be sure we are conscious of the fact that this represents. Okay, very good. If there are no questions, there is one additional question in the back. Yeah, we'll move to the.
Sorry, this is a question from the web. If everyone's
fine.
down in the room, if that's okay. It's from Pierre Chedeville at CMCIC, and he asks, "How do you respond to higher competition coming from banks in the protection and health business in France, and have you lost market share?"
No, I don't think we have. It's clear that the banks, which are struggling because of the, I would say, the situation in terms of interest rates, they are trying to generate more revenues from other activities. Well, it's something we've been knowing for long. If you look at what we've been doing, I don't think we have lost market share. If you look at the health market as an example, we have lost through the last evolution of the regulation in France some individual clients, but we have gained group clients through the ANI reform. So, I mean, it's a fact that banks are trying to do more. I don't think we are necessarily victims of it. On the contrary, I wouldn't.
And if I may add on this, first, the fact that banks are very present in the life market in France is
no news.
They have had for many years more than 60% market share on the French life market. On the protection side, 2015 was extremely successful for AXA France. And you may have noticed that there was a change in regulation that was done in several steps for mortgage insurance. Where the banks essentially were doing a tide sale, and where now they have to tell their customers that they have a choice to take the mortgage insurance from a different provider. So overall, our protection sales have a very good future in France, and 2015 was already very successful.
Another question coming from the web? No, it was the only one? Very good. So I think on this happy note we are going to conclude. I mean, the food industry is trying to take salt and palm oil out of their products. We are trying to take coal out of our investments and capital out of our new products. Happy afternoon. Thank you.